The objective of the tutorial on freight market analytics is to take one time series, which is freight earnings for a specific type of ship, and do some analytics, which we can use for operational and investment decisions. We are trying to work out the probability of what prices will be in the next period of time. We start with one single time series. Here on the first sheet, we have the earnings for VLCCs. The data is monthly, and the earnings are in dollars. In January 1990, for example, a VLCC was earning around $29,000 a day on average. If we plot the data, we will get a good understanding of what the data looks like, what the volatility is, the maximum, mean, and average, and so on. This simple plot will give you a good view of the markets. You can see all the peaks and troughs. Since this is the spot market, we can see that it is highly volatile, price change on a daily basis. This is the average earnings over a month. If it was daily, the volatility would be even more. We can now do some basic statistics. We can work out the average, maximum, and minimum. We will build some thresholds and insert some lines to see where the average is, the high values and low values, so that we can have a range. To do this, we go to Data, Data Analysis, and click on Descriptive Statistics. If you don't have the Data Analysis tab on your spreadsheet, you can select the Analysis Toolpack from the Excel Add-ins category. Input the data range here in the Descriptive Statistics. Select the data with the earnings. Tick the label box, Summary Statistics, and click OK, and it has given us some basic statistics. We have the average and standard deviation, which we will work with. This is the average overall in terms of earnings over a whole period of time, and standard deviation is the range that we can look at in terms of volatility. One standard deviation based on a normal distribution means that the freight rate could be $29,000 more or less, and that is a huge range when we consider the average. This means that we can have big swings. As already mentioned, this data describes the shape of the distribution. Once we have done the basic statistics, we can begin to add these values here and create a table like the one we have on the second sheet. The VLCC Analytics 1 sheet does this. We have copied and pasted the mean against every observation so that we can use the information for graphs, and we know what the standard deviation is. We have used these two numbers to create the table. The first one is the mean. The high is the average plus the standard deviation, and the low is the average minus the standard deviation. They are constant values. We have plotted the data here in this graph. We have the spot earnings, the thresholds, which are the high and the low, and then the average. These are good indicators that tell us, for example, the average earnings. But when we look at the swings, it is a false representation of what is happening in the market over here. For example, if we look at the one specific period, for example this one here, it looks okay, but this period here is way off. We need more than the average. We need something more dynamic. And this is what we have on the second analytics sheet. But for now, it will be interesting to find out how many times earnings went above or below average. We can do this quite simply by using conditional functions in Excel. We have a conditional function here. If we look at the formula, we are asking the following question. Is this freight rate higher than the average? Yes or no? If it is higher, which is yes in this case, give me 1, and if not, give me 0. And the next column is the opposite. If this is 0, give me 1. Otherwise, give me 0. Now we have an indication of when it was higher and when it was lower. Above, we have calculated a simple probability, which is a percentage. Looking at historical performance, what was the percentage of when earnings were higher than the average or below the average? We can see that 65% was below average and 35% above. This tells us that we have large outliers. These volatilities have pushed the average higher. They are not a good representation of what the dynamics of the market really are. When we do some more advanced analysis, we want to make sure that these outliers or spikes are taken out, so that our analytics is more representative. This is for the overall period, but we can run the statistics for only 1 year or a couple of years. Here we have the last 4 years, and we can see a significant difference. The last 4 years have a lower average, and the volatility is much less. Next, we will do a probability calculation, where here, what we have is the probability of this freight earning being below or above a certain value that we indicate. We have 3 scenarios, $1,000, $2,000, and $20,000. We have based this on a normal distribution. The formula is provided here. Looking at all the data, this is telling us that the probability of this ship type earning below $1,000 per day is 10.5%, and around 11% chance of it earning below $2,000. But the percentage goes up when we look at $20,000 per day. Looking at the overall historical performance, there is a 27% chance of the earnings being below $20,000 per day, but if we take only the last 4 years, the percentage of this probability is higher because the market was generally weaker, so there is a fairly large probability that this ship type will earn less than $20,000 per day. The next stage is more dynamic. We have done some color coding here in earnings. Based on an Excel function called conditional formatting, where the cell color changes based on a formula that you insert or a condition, we will come back to this in a minute. We will have the average, standard deviation, high and low, but they look different, more dynamic. The average is not fixed anymore. We can see that the average in the first cell is equal to the first value, and the average in the second cell is the average of the first 2, and so on. If we click here, we see that this is the average of all previous information. It builds up with new information. It has its strengths and weaknesses. At some point, it almost becomes flat because of all the input information, but it can be used as a moving average, i.e., 1 week, 1 month, or 3 months, etc., depending on the assumption that we want to make. Here we can see that it is taking all this information. The same is for standard deviation. It starts with a small amount of information, which builds up. The high and low is the same formula as we had before, but now it is linked to the dynamic mean and standard deviation. This is the plot of data. We can see that this is still earnings, this is high and low, and this is the average based on these dynamics. When we compare them to the previous page, where we had flat lines, here we have more dynamic graphs, where the lines adapt to market changes. Here, where there is not much happening in the markets, the lines are close together, but over here they open up to account for these changes. Again, we have the probability of earnings being below certain values, $5,000, $10,000 and $30,000. The calculation of these probabilities are based on this dynamic structure, which is illustrated in this plot. The probability is very low for earnings under $5,000 and $10,000. But at the $30,000, the probability is much higher, at around 51%. Now we can see the swings in this dynamic data. The probability is going up and down in response to what is happening in the market. The low earnings probability is generally unchanged because the probability of getting these earnings is very small compared to the higher earnings, so this line is more representative. The conditional formatting was based on these three scenarios. If we click on a cell with a condition and go to Home, we will find the Conditional Formatting tab. If we click on Manage Rules, we can see all the rules applied to this sheet and the colouring. What it is basically saying is that if the values is higher than the fixed cell, i.e. K2, which is $30,000, I2, which is $10,000, and G2, which is $5,000, then give it a specified colour. It will have a different colour if it is higher than 30,000, or between 10 and 30,000, or between 5 and 10,000, or if it is below 5,000. If we change these values, then these conditional formatting values will change. If we insert $20,000, we can see that they have changed based on that. The colour of these two cells is orange because they are between 10 and 30,000. These cells are green because the values are above 30, and here we have yellow between $5,000 and $10,000 and pink below $5,000. Here, as before, we indicate 0 and 1, but now we have conditional formatting as well, for when it gives us a value of 1. The Excel file is available in the Resources tab for you to see some analytics. Work with it so that you can understand how you can use such analytics to make strategic decisions.